Stop. Do not do that Roth conversion you've been planning until you've watched this whole video. I'm going to show you why I believe 99% of people should not do Roth conversions. And that seems like a controversial take, but I'm going to show you an example of a couple with roughly the equivalent of 4.1 million in tax-deferred money when RMDs hit, and I recommend that they don't do Roth conversions. And you're probably thinking, wow, that's against everything I've heard in this space. Well, I disagree with a lot of this space tells you, so that's why I'm doing this video. Why is this controversial? Well, I have a list of about 20 different things that can be detrimental by doing, you can be hurt by doing Roth conversions, okay? And I was like, I'm gonna do this big marathon video with all of them. I'm not gonna do that. At the end, I'm gonna put the list up and you can look at the 20 things that I've just listed out. I've narrowed it down to 3 main things that are reasons why you should not do a Roth conversion, okay? And if they apply to you, then you should really rethink doing a Roth conversion. So we're going to jump right in. First of all, hi everyone, my name is John Lee. I'm a tax professor and a CPA, and I love tax strategy, I love tax planning, I love maximizing after-tax wealth. And that's why I'm so passionate about this topic, because I keep going back to it. I'm like, why is this pushed so hard? Because there's so many things that I don't like about it that I feel like I had to get it out there. So disclaimer though is this information is for educational purposes only. I don't have your specific situation, so you need to consult a professional for your own situation. But I want to give you some knowledge here. Before I jump into the case study, if you've seen my other videos, this is the 5th video in my series on Retire Smarter with a Pension. If you've been liking the videos, please give them a like and subscribe. It really will help me out to get this information to more people. Even more importantly though, if you can share this with someone you know that's close to retiring or has a pension or is looking into doing Roth conversions, this could help them be more comfortable in the decision, because I know a lot of you that are looking into Roth conversions and trying to pull the trigger, gosh, it's painful because you're like, I'm going to be paying a ton of tax and I don't know if this is going to pay off, because it's all about future assumptions. So I want to try to ease your mind on some of those assumptions. The other thing I wanted to mention is, as I'm going through these examples and the reasons why you shouldn't do a Roth conversion, comment on ones that stand out to you that you think, oh man, that hits me hard. That's why I'm not going to do it. Or you might have this is like a 50-50 argument. You might be on the side like, I'm doing all Roth conversions, here's why. And please share that. I love the discussion, and it'll provide more value to people to see, okay, what are reasons people are or aren't doing this? I just like putting real numbers to it. So I'm going to be going through a real example year by year so you can see the effect, right? Sometimes you put this in software and it says, you're going to save $1 million. You're like, okay, I better do 24% for 5 years. And you don't realize the huge detriment that could be. So reason number 1 to not do a Roth conversion, you are not going to be killed by taxes like everyone says. Everyone says, IRMA's going to kill you. The RMDs, once those hit, you are going to be paying so much tax, okay? That's why I love having this real client example. Let's pull it up. We have this couple, okay? Here is their current net worth, retiring in the next 2 years, okay? Tax deferred money, they already have $621,000. They're going to have $800,000 when they retire. They have some tax free, some Roth already, okay? House, cash, etc., okay? They, believe it or not, this couple, looking at their net worth now, you wouldn't know that they're in the top 1%. And the reason is for how strong their pensions are. They both have a pension. If you have a pension, you are very blessed, because look at the effect of the pension. The pension is like, you'll see for this couple, their pensions are the equivalent of having 4.1 million when they hit RMDs, okay? So which is top 1%. So let's look at their dashboard. You can see lifetime income sources. You can see right now, this is when they start retiring and only taking pension. They're kind of waiting on Social Security. In a later video, we're going to talk when should we take Social Security, but you can see these years, this is before RMDs kick in and then RMDs kick in, okay? And you can see this is why the financial industry scares people. They're saying, you're going to be pulling in 300, they get up to 400 grand during the RMD years. And everyone's like, you're going to pay so much tax. Look how high your income is. Okay, look at their effective tax rate. This is according to the current tax rates, okay? And you can argue, oh, they're going to go up. We're going to talk about that, okay? Based on where they're currently at, in their working years, they were in the 22% federal bracket with 4.5 state, and then you're paying Social Security and Medicare tax. So they're paying, their effective tax rate was in the 26th percentile. You can see that last year when they were both working, we're up there. And in the first four videos, we've already done strategies to decrease that in these years as they're getting up to retirement. But look at their effective tax rate during retirement. Remember how they were supposed to be killed by taxes? That year that they have 400 grand in income, right? Look at their tax rate. They're 17%. So they're still paying a percentage way less than what their working years, okay? But people are going to say the widower. Look, once the widower, so it's assumed that the husband passed away first in this case. So for the last 3 years, the wife goes up to 22%. That includes federal, state, okay? That includes IRMA, because she actually, that widower, when that kicks in, she kicks into the IRMA bracket for single. If I go over to the IRMA calculation, they're not in IRMA at all, even with 400 grand, because it's inflation adjusted until the husband passes away. She's paying 9 grand a year in IRMA, and you're like, oh, that's terrible. Look how much income she has. She has like 450,000. 9 grand is nothing. Okay, so these are things that people try to scare you with IRMA and stuff, but the percentage is so small. Look, her tax rate goes up to 22% versus 17, going from married filing jointly to single. Okay, well, let's project. Now I'm going to hear, oh, what if one of the spouses dies way earlier? What effect is that going to have? So let's just say instead of living to 86 and 89, let's say the spouse dies at 75. Okay, and let's look at our chart again. Okay, the rates jump up. Oh, she's hitting the 20s earlier. 20%, okay, look at her cash flow, okay, because that's still way less than what they would be paying in their career, okay? And so, first of all, we're saying widower tax, you're paying a lot higher for the rest of her life, 20%. But look at her cash flow. Look, when the widower tax kicks in, she's now in the 24% bracket. She's barely into it. But her effective tax rate with everything is around 22, okay? So, is that killing her? You know, she has cash inflows in these years. There's less inflows when the husband passes away, right? She only has 179,000 in inflows, and her expenses and taxes, in those increased taxes and everything else, are only 102. She has an extra 80 grand a year. Is she hurting? Are taxes killing her? They're not. And so I'm going to get into, like, look, taxes aren't going to kill you, okay? This is the extra cash flow. This chart is the net, that 80 grand extra, okay, per year that she's going to have. And look how much extra they have in the years that everyone's saying do Roth conversions. Very little extra, okay? So I just wanted to kind of relieve your mind, like, okay, taxes, if they stay the same, you're not going to get killed by them, okay? But everyone's saying taxes are going up, right? Or national debt, it's not looking great, right? Social Security's running out. Do you think they're going to tax retirees? Is that going to be the first group they go after? I don't know. I doubt it. All the videos, no one really explains why retirees are going to be the ones taking on that tax burden. My thought is, gosh, Social Security is about to run out. What are they going to increase? Social Security taxes, right? They might increase that percentage, or maybe instead of 176,000 is the threshold where they collect Social Security, they'll raise that. So they're putting more tax on the wealthy, okay? So, but just to ease your mind, okay? So if you're still saying taxes are going to go up, let's look at, I tried to build all these things in so you can project them easily, okay? And so what if taxes go up? Other assumptions, we're going to increase taxes by 100%. So like if the Tax Cuts and Jobs Act had expired, on average, they were expecting taxes would go up by 20%. Let's say in that first, let's say in 2037, in that year they start taking RMDs, when everyone says they're just going to be killed, right? With the equivalent of 4 million because of that pension, you know, those are huge income levels, okay? We just increased those taxes. The baseline was where we were at, that green line. How bad is it once taxes go up by 20%? You're paying 25, 23, 24%. This widow still has extra, like 70 grand in extra cash, okay? An extra 10 grand difference, okay? Is it killing her, all that extra cash? It's not, even 20% increase. I mean, we could even put it to 100%, okay? Just to, you know, sometimes we do the doomsday, 100, oh, we have to do an override because it's so high, 100% increase in the federal tax. You're still, you know, she's still, look, her graph, she's still over her expenses. I mean, she still has 51 grand a year extra. She's in the high 30s paying that tax. So Does it kill her? You're paying a lot more tax then, but does it matter as much when you have 400,000, 300,000 a year? Because your RMD, your Social Security, everything else, it doesn't. If you have an even lower balance, lower guaranteed income in those years, you're going to see your tax rates much lower because the tax brackets are inflation adjusted. So that's my first argument, is when people are, and it's almost every video that's saying do Roth conversions, it's saying taxes, like we just did, if your tax doubled and you're still not killed by taxes, okay? So keep that in mind. And that's going to apply. You know, it would hurt to pay 35%, but the next arguments I'm going to give you, I'm going to show you ways where it's up at 30, we drop it back down to 20, okay, with some of the strategies. And there's strategies that you lose when you do that Roth conversion. So that is reason number one. You are not going to get killed by taxes. Now for reason number two, how much is the psychological damage of doing a Roth conversion, okay? All of you get ready to pull the trigger on that conversion up to the 24% tax bracket. How are you feeling? Are you feeling excited about paying all of that tax to the government right now? That's painful, right? And so I commiserate with you. That's why I'm like, man, is this the best thing? So I want you to consider this. Look at this couple situation. And part of the reason why I bring this up is I saw a comment on another video where someone had literally converted all of their traditional accounts. They had 5.6 million or something in traditional accounts. They converted it all to Roth in 1 year, and they paid 2.6 million in tax. Okay, and I'm loving that tax-free growth later, but that is a lot of tax. And what it kills me is, as a tax guy, I'm like, there is tax strategy you can apply for your whole life. When you do these Roth conversions, you're pretty much closing the door on that. That's my reason three. But let me get back into reason two, the psychological effect of this. And the reason I bring this up is, how painful is it to pay the tax now? You're getting ready to pull the trigger. Look at your cash flows. Why is it painful? Well, let's look at your net assets. At least this couple, because they have such healthy pensions, and if you're doing pretty well, like usually these Roth conversions are recommended for people who have a lot of money and traditional to transfer over, right? Early on in their career, when everyone's saying to do Roth conversions, they may have a lower balance than later on, lower income levels. You can see, for example, in these years, the husband stops working, so their cash flows are lower. So you can see these years when it's a prime time, you know, these first years when the tax rates are low, that's kind of the prime time where they're saying, before you kick in Social Security and stuff, maybe do Roth conversions here. But those are the years where you have less leeway, right? And if one spouse, and it's a lot of times when you retire, and it's between retirement and when you're taking Social Security or taking the pension, convert in those years. The problem is in those years, yeah, like we're saying, your cash inflows are a lot lower because you're no longer working. You still have the same expenses, so you're feeling, oh, okay, I have a lot less wiggle room. So what's happening is they're saying, dig into your, since you have lower income, dig into your other accounts. So you remember our net worth, it's saying, okay, you're going to have to start depleting your cash. You're going to have to deplete the taxable account, and they don't have one here. Or like you would have to pay the conversions out of your tax deferred account. All of those things are painful to do because the balances aren't huge now, and you're like, okay, I'm going to take a huge hit on these, but it's going to grow tax-free. So that's psychologically, that's hard to take that hit. Let's look at an example of how painful that is. So we're going to, a lot of software, like this couple's example, let's go over to our future planning tab, and this is where we're going to project a Roth conversion. In our tax section here, it gives you their tax rate. And you can see with software, it's going to say, oh, you're in 12% bracket here, okay, for these 1, 2, 3, 4 years. Let's do some Roth conversions, because they have such a healthy pension, they're going to be in the 22, 24% bracket. And this is with that increase in, I'm going to go reset us on the profile tab. I'm going to reset us back to our baseline. We did the catastrophic 75 and huge tax increases. We're going to kind of go back to baseline to show you without the catastrophe, okay? So for future planning, you can see they're 12% and then they're hitting 22% for a long time. So people are going to say at least you need to get up to the 22% bracket, which in my first opinion, I was like, they should probably do that. But as I did more analysis, I was like, they shouldn't do that. So here's why. Let's go over to, well, let's save this page because we're going to see you have your taxable income without qualified dividends and capital gains. That's your amount. And then up to the next bracket. If you put this in Bolden or these other softwares, they're going to say you convert up to 24% at least. A lot of them will say 32, right? In those years. Well, look what you have to do in those years. So I have another tab open, and I'm just going to jump back and forth so you can see the effect. So this is in our cash withdrawal section. This is where you do your withdrawal planning. So with the Roth, we can just do this year by year. That's what I love about this, is you can see the effect every year of the decisions you're making. In a lot of softwares, it's like, I want to do up to 22%. It just does it for all the years, and you can't manipulate it. Here you can. So Roth override. So the first year, the software is going to tell us go up to 24%, and you'll see why. So we need to add 136,510, convert that much of the husband's tax deferred. He has 509, so we're going to do, what was it again? 136,510. 136,510. When we do that, net worth just increased by like 80,000. Okay, and that's the effect of this software. It's saying you're going to have a higher net worth. The problem is you reach the big benefit of that when in these projections when you're 85, 86. So they're just, it's a long time away, right? So we do that first year, you see a big jump. Next year, you can see now that year we've hit we're exactly at we've maximized the 22% bracket. So we were at, did I pass it? Yeah. Well, we're up to the 24, so we filled the 22, because software is probably going to say fill the 22 and 24 to maximize your lifetime, right? Well, I'm going to show you so many reasons why things that aren't considered in that decision, okay? So the next year, 148,256. 148,256. And before I hit enter, look at final net worth. Just jump by another 60 or something, okay? So you're seeing Roth conversions. That's why everyone's preaching them, right? 176,250 for the next year. And we're really depleting the husband's account. You're like, sweet, we're going to have no RMDs, okay? 176,250 increased again, okay? And finally, that last year we were in 12%. Let's do 123,028. We're going to do it from the wife's here because the husband's is running low. So 123,028, 123,028. Okay, we've now, the software says convert up to 24% for those years you were lower. So we've done that, and it might have them converting, oops, I have it on the other tab. It might have them converting more years going through, but you can see we saw a substantial increase in net worth. So let's lock that in as a projection. So projection, our last projection is after we've already done 10 projections with all of our previous strategies. Now let's do our Roth conversion strategy. So we're saying up to the 24%. So I'm going to set projection 11. Okay, and so from projection 10, this is what the software is going to show you. Just in those 4 years, you increased your net worth by $250,000 by doing those Roth conversions. Okay, so now you see that and you're like pumped. You're like, that's a no-brainer. $250,000 more money when I die. The problem is all of these softwares look at when you die. It's not when you retire. Look, we just decreased our retirement net worth. Same thing. You don't just look at final net worth. How much did you have at retirement? We were at 2.259 million. Now we're at 2.182. So that's where we're taking the hit early on, okay? And what I want to show you is when you're taking that hit on that future planning tab, in your cash outflows, those years, this is why it's painful, okay? Baseline tax before was 30, 23.7. We've increased it. Now we're paying 55, 50, that's how much extra tax we're paying each year, 45, 33, you know? So that's why people are in pain when they're doing these conversions. They're like, I'm paying $134,000 in tax within 4 years. That is painful. Remember their account balances? How much, you know, that their account balances, their cash, they're way under their emergency reserve. Do you know why that hurts? That's why. Because the software is recommending, look, your net worth is going to increase by 250, but you're going to take a huge hit right now, and you're going to feel it. And when are the years where you should be enjoying retirement the most? Your go-go years, those early years, right? And so that first year, you know, we just increased our tax rate to the 20% with those conversions. Look at our cash flows. Now we're underwater in those years. So we're taking from savings. We're taking from, if you're taking from your tax deferred for the Roth conversion, it's even worse. But here you're having to dig out of your cash that you had and you're way under. So do you think you're doing any vacations during those conversions? Probably smaller ones than you should be taking, okay? And so we did those conversions. Look at your net cash flow. You increased it when you're 75, you have 15,000 more a year, okay? The difference between 80,000 surplus and 95,000 surplus when you're 75 to 90. Are you going to care? I bet you won't, okay? But are you going to care when those first 4 years, you're like, man, we just retired, we're supposed to be living the life, and we have to eat ramen noodles again because you're cutting everything so low. These are things that's why people hate doing these Roth conversions, is it's painful. That the comment I read when they had 5.6 million and they paid 2.6 million in tax, that hurts, okay? So that's the first one. And it makes it even worse because a lot of these long-term projections, they assume the difference, the benefit gets even bigger as you make your life longer. So they're like, okay, you know, the benefit was 250,000. What if you live till you're 100? Okay, and then you see this massive explosion in net worth, and it's because, yeah, your Roth gets bigger and bigger, and at that point it just starts exploding. But it's like, gosh, what if you die when you're 75 and you never saw, you know, the huge growth never happened, but you see how big a difference the age makes, okay? What if you both die when you're 75, okay? And you never see the benefit from prepaying that extra 140 in tax, okay? There is so much risk in Roth conversions that I just think is completely ignored, okay? So, and I'm just trying to shine a light on that a little bit. So let's go back to the expected age according to the Social Security Administration, okay? So I've hammered on those two. It took a little bit, but that is, you know, it's important stuff, okay? So let's talk about our third reason, okay? And this, as a tax guy, that psychological reason is probably the one that's not mentioned as much, that I don't see as much, where when you're best off, you're doing a Roth conversion, so when you're worse off, you can pay more tax, and when you're better off, you pay less tax. It just doesn't make a lot of sense, okay? So this last one is my favorite because I'm a tax guy, and I love tax planning. I love minimizing taxes. When you do a big Roth conversion, like this couple, if we do that 24% Roth conversion, I lose all of my planning opportunities, okay? Because you have this huge sum of tax-free money growing tax-free. Great. You know exactly what's going to happen. It's never going to be taxed. The problem is there's so many ways that you could have taken that tax-deferred money and increased your wealth substantially, okay? Or built a legacy. That's not just a legacy for your kids or your inheritees, right? When you have this kind of money and you've saved up and you've done so well, locking it in, like paying all that tax and locking it into Roth, there's like studies out there that say people never spend their Roth. That's the last thing you spend, right? Because you want to be more efficient. Well, guess what? If that's what you're giving to your kids, what are you doing when you convert it all? It's all in Roth. Now you're less likely to use it because you're like, oh, that money's for my kids. I need to let that grow because my kids are going to get that. You've worked your whole life. Do you have to give all of that to your kids? You should enjoy your money as well. And I think I'm realizing that psychological aspect. I think it's harder to use your money when it's in Roth. Comment and let me know because I'm new at this, okay? But in my mind, like, I never want to use my Roth, same thing. And I'm funding my Roths for the same reason, but I'm putting way more in traditional because I know. Look at these strategies that you lose out on, okay? This couple, the first strategy, this is where I'm talking legacy, okay? So instead of thinking, oh, I'm just going to give all this tax-free money to my kids, think of, okay, I have my kids, but I could do a lot of good in the world. Like, I have millions of dollars. I'm going to find some charities that I'm passionate about. This is probably the #1 best thing you can do in retirement to get rid of tax-deferred money. You took a tax deduction on the way in. That account grew huge. Now you have this huge balance, and you can go give it to charities and never be taxed on it. And you are accomplishing like a huge thing in life. You are benefiting more than just your family. Like, you can benefit a lot of people. For example, look at this couple. On their profile page, I have this assumption in here. So we're going to assume they're already assuming that they're paying 12% in charitable. That's what they do already. They're just going to keep doing it their whole life. So if that's the case, if we go over to our future planning, now we can go year by year and say, okay, based on their income levels, once you turn 70, there's this thing called Qualified Charitable Distributions. That is the coolest thing ever. They're already paying $21,000 in charitable based on their income. They're paying 12% of it, okay? What they can do, if I scroll over to the distribution section. So this is where they're, instead of doing conversions, I'm going to take those out, because what we can do is, because they've already depleted their tax deferred accounts, so they're losing the opportunity. Husband only has 133 left, so he could still do this, but to a lesser extent, okay? What I'm talking is, instead of doing those conversions, we dropped our net worth down a ton again. Every year, they can, so when, as of 70 and a half, what they can do is a QCD. So instead of doing a Roth conversion, let's jump back and say, okay, at 70, we're going to take $21,899, and watch your net worth, $8,272. See how fast that's growing? Like, instead of converting it to Roth and just like taking a big tax hit, when you're 70, you can take that money straight from your tax deferred account, pay it straight to a charity. And you have to do it straight to the charity. But then how much tax did that save you? That first year, you want to talk tax savings, you just saved $6,000 in tax. You were already paying $21,000 anyway. Hopefully when you have that much money, you're like, man, I have money to give. I can support these causes. $21,000, you just give it straight from your tax deferred account, just saved you $6,000 in tax. Every year you do that, you're going to save $6,000 in tax, okay? So but it's going to get bigger as the amount goes bigger. So just for example, let's do the next year, okay? And just watch the growth each year we do this. So now we're not paying that 21 out of pocket, and that's why you see that increase, because we're saving tax savings. And now we're not paying it out of pocket, we're paying it from our tax deferred account. So we got a tax deduction, never paid tax on it. 22,592. So 22,592. We just jumped another $17,000. Okay, so every year, because you're getting growth on those tax savings, they're going to grow for the rest of your life. So every year you're getting $17,000 in savings from paying money that you would have paid already, but now you're taking it out of your tax deferred. Okay, they can do this the rest of their life. So I'm going to 23,313, 23,313. Okay, look at every year we're growing by 14,000, 15,000. Okay, so I'm going to go ahead and enter the rest of those. So in this example, we were just doing the QCDs from the husband's account. So you can see, what is his RMD now? They just, instead of paying their charitable out of pocket, they paid it straight from his tax deferred account, and their RMD is down to 250. You know, it gets up to 20 at the end. Okay, look at this strategy on their taxes. Okay, look at their effective tax rates. They're at 14, 16, 17. They've dropped to 11, 12, 13, 14. Just with that one strategy, okay? So if you lock in that Roth conversion, guess what? Do you have an incentive? Like, it gives you more incentive to give to charity if you have all that tax deferred money. It's a forced giving thing, right? So, but if you lock in all that Roth, is it harder to give that Roth money to charity? I bet you it is, because you're thinking, that's allocated for my kids. I can't give that one to charity. So that's my favorite, is the QCD. Look, their lifetime, every tax rate we dropped. That final one, so the thing with QCDs is, you know, with that, they have all that extra cash flow. They could increase it a bunch more. They could double it. You can do up to 100 and, I need to look at the threshold now, but 110,000 or something a year per spouse. So each spouse could go ahead and give, you know, extra. So if they're like, we still have, look at these years, we have $100,000 still in extra cash flow, and you've already distributed a bunch to charity, do you know what? We're just going to completely distribute our tax deferred accounts. What the spouse can do is, you guys can take, you do all those QCDs, so that's what you were giving anyway. At the end of life, in our projection, you can see, let's set projection 12 and just label that QCDs. Okay, how much did QCDs do for us? So we actually increased from projection 10, just by doing QCDs, we increased significantly as well. Okay, now let's go to what you can do at your end of your life. You still have, even with all those QCDs, you still have 1.2 million. So what you can do is, you're going to pay $337,000 in tax on that. So you can either do more QCDs up to $220,000 a year, or just say, okay, I'm going to just leave the remainder to charity. And at that point, when you go to profile, in charities tax on tax deferred, we're going to do 0 because if it's a charity, they inherit it with 0 tax. Okay, so, and you can see in our projections, set projection 12, and that one is QCDs / leave remainder to charity. Okay, if you've done Roth conversions, you've lost that opportunity to do that strategy, which, you know, that was an increase of 139 more than the Roth conversion strategy of your total net worth. But keep in mind that you're giving a ton to charity, but you still have to heirs, you still have almost 7.5 million to give to heirs. So it allows you to do these strategies like give more to charity. What else does it allow you to do? In those years, we just decreased our tax substantially over our lifetime. Okay, the other thing that it allows you to do over those years is, you know, we've, like, the tax rates have gone down every year, and then they're gone at the end. You just lose the opportunity to plan. If you did a Roth conversion, you're like, okay, I'm just taking out tax-free, I'm not paying any tax. It feels great, right? But now you don't have strategy. The other thing that I thought of, I'm like, man, a retiree, you have so much, like, if you have extra cash flow, like, what can I do with this? When you have the higher taxes, you could literally do the strategies that the rich use right now. Like high income earners do their strategies. You're not even in the 35, 37 yet, but if you were, what do people do that are in those brackets? They're buying a rental property every year, and they're doing cost segregation studies and writing off hundreds of thousands of dollars of depreciation. What's amazing about those strategies, you can get a tax deduction depending if you meet the short-term rental rules and so forth, but then when you pass on real estate, you're taking all this depreciation, real estate passes on tax-free as well, just like a Roth. There's so many things you can pass on because you get a step up in basis. You could be buying a rental every year with that extra cash flow, but when you do the Roth, you don't have as much cash flow, and the deduction doesn't mean anything to you in that case. You're like, I could have done a segregation study, but I don't really need to because I just have all this tax-free money, you know. So it changes your incentives for like maximizing your tax strategy because you just made that one decision. I'm gonna do this Roth conversion. Okay, so I have been hammering on Roth conversions, right? Because so this couple, like, they have no reason to do Roth conversions based on everything we just went through. Okay, and here's the list. Take a screenshot of that list. Those are just things I was like talking about, Irma, you know, converting now and going over the ACA cliffs. There's just so many different things that I wanted to list out a bunch, and there may be even more that I'm missing. So that being said, if you've done Roth conversions, it's not going to kill you, right? But you know, it might be that you're going to be great for retirement. It's going to feel great, especially. But if you think about it, this couple, their RMDs are on like a $4 million balance because of their pension and so forth. If you're under that, or if you're under 500,000 and you're thinking, man, I got to do this Roth because you need to run your projections like and take out that 90 or the age that's way up there. And if you drop it 5-10 years, you'll be amazed at how much of value you lose from that. So maybe there's other ways to increase your wealth without taking that huge tax hit this year. So that's it, guys. I hope if you're still here, you can see this My Financial Independence Plan is pretty powerful. I'm giving away a free version. The link's in the description that you can use. You can't do quite the modeling we're doing with the free version. I'm still trying to clean this up, make it as good as possible so it's useful. Like, you can do those year-by-year projections instead of saying convert to 22% and you're like, why is it so good? You know, I want you to be able to see everything that's happening. So I'm doing 20 plans. I just sold another one this weekend, so I'm down to 18. So if you want to be one of those, I'll do your plan with you. I'll do all these strategies with you. And this is the lowest price I'm ever offering it because I'm just like building it out right now to expand on a bigger basis. So if you want to be one of those, send me an email and we'll get you started. Thanks, guys.